Welcome to Wednesday webinar. Tonight I'm coming to you from Plantation Point, one of the best dog-friendly beaches in Australia. Tonight we're going to discuss Subdivision 101. The simplest start is cutting off your backyard and selling the land. I did this about 10 years ago myself, and it cost me $70,000 in fees to get and fill and drains and all that right to get council approval for the subdivision, and it took 2 years. Still very happy with it. Made a lot of money out of the land. That's not a problem, but it's not an easy task, so please put in some planning. I was registered for GST in my own name for when I first started practice, and I still continued that registration. And before I started the cutting of the back block of land off, I deregistered personally for GST. I was already trading under a family trust anyway. It really was no reason to continue with it. So I deregistered, and I did that just to make sure that I never had to have the argument with the tax office that that block of land was part of my enterprise that was registered for GST. See, I had practice from home. Thought it was a very slim chance, but may as well get rid of the registration. If you sell vacant land and you are registered for GST, and it's part of that enterprise that you are registered for GST, you have to charge GST. And I'd had that land for a long, long time, so even with the margin scheme, there would have been a lot of GST involved in it. But if you're not registered for GST, there's nothing that makes you registered for GST as long as you're merely realising an asset. You're just cutting off the land and getting rid of it in the simplest way possible. Then you don't have to register for GST, because the $75,000 threshold to register for GST is all about your turnover, not about capital assets. So the sale of a capital asset does not contribute to that $75,000 test, and therefore you don't have to register for GST. But if you take it one step further and start building on that land down the back, say build a house to hope to make profit out of that, then you have started more than merely realising an asset. You're going to have to charge GST, because your turnover on your business, which is building houses and selling them, exceeds $75,000. There's a couple of reasons I chose not to do that. That's the most obvious one. And the other reason was that I didn't want to take the risk of dealing with the builders, and they're making their profit. What little profit was left for me after the GST and all the rest of it. So it was just much easier, but you've got to do your own due diligence, crunch your own numbers. Maybe it's worth it. Just don't forget to take the GST into account when you do. And another thing that will happen once you've deemed to be doing it for a business enterprise is it's no longer capital gains tax on the profit. It is normal business profit. So effectively you lose the 50% discount. Now, I even went as far as speaking to a solicitor about possibly selling my whole block of land and the house to someone else who only wanted the back block, and then they sell the front block, my house, back to me. And so I've sold the whole thing off with my main residence exemption and not have to pay any capital gains tax at all. Unfortunately, the stamp duty was more than what I was going to save in capital gains tax, so I ducked and I weaved, couldn't get out of it. I faced up to the capital gains tax. Now the big question is, how is the capital gains tax calculated? Well, I start with, there's no market value reset, there's no main residence exemption. My main residence exemption still stayed on the front of the block with my house. I've just got a block of land down the back that I'd bought 13 years earlier, so it's half the price I paid for that land because I actually built the house at the front. It starts my cost base. And then you add to that some of your subdivision costs. You see, any cost that split the title in two is a cost associated with both blocks of land. So you've got to split them 50-50. But things that were specific to the block down the back, like the fill, the drains and that sort of stuff, putting water on down there, that goes in the cost base for the land down the back. Also, because I bought the land after the 20th of August 1991, I was allowed to increase that cost base by any holding costs. In this case, if I kept the receipts, a bit of lawnmower fuel, and fencing, and a bit of your rates. Not much of your rates as it applied to that land, but you can increase it a bit there. And in most cases, you'd have interest on the mortgage for that land too. Fortunately, I didn't have that problem. So then you calculate all that through, deduct it, and add to that your selling costs, such as your real estate agent fees. You also don't forget to increase it by half the stamp duty when you first bought the land, and then you deduct that from the selling price. That gives you your gain, and then you get your 50% discount, and that's how much you pay tax on. Thank you for staying till the end.